Hello, this is Andy Michael with Seven Springs Wealth Group. To start 2022, it feels like there's a lot of lions, tigers, and bears in the market. Or better yet, rates, inflation, and invasion. We want to give you a few perspectives on each of these topics and a couple of takeaway actions of what we can do about it. Let's start with the king of the jungle, with rates, thinking about the Federal Reserve and hiking interest rates. There are 6 rate hikes cooked into the market currently, and it's predicted to top out somewhere around 2 to 2.5% in 2023 as of today. So a couple of perspectives on this. That still means that rates are staying historically low, still very accommodative for risk assets in the long run if interest rates top out at 2 to 2.5%. That also means that we think housing demand and pricing can continue to be higher. As rates are going higher, home buyers are looking to get into a house quicker and faster to lock in a low mortgage rate before rates increase. So we could still see very strong housing demand in 2022. Now, rising rates are bad for bond prices. As rates go up, bond prices come down. That's what's happening today. Going into the future, that means that we're going to get interest on our bank accounts, and our bonds, as they mature and reissue into new bonds, are going to be paying higher interest rates. So higher rates for savers and investors in the long run can be a good thing. Let's talk about inflation. We have our tiger here. He was lurching in the grass. Now he's jumping out. And that's kind of what we're seeing here with inflation, with a 7.5% January inflation report. Do want to bring attention to the 5-year break-even rate. This is where the market thinks inflation is going over the next 5 years, still at 2.9%, much more moderate than the 7.5% prints that we're seeing today. So our perspective here, we've talked about this some in the past videos and articles. Prices are not going down. So, the items that you're seeing in the store, even though each individual item will have some fluctuations, in aggregate, prices are going to stay at this level or higher. So don't expect things to get cheaper. Eventually, though, those prices should stabilize, so we won't have this rate of increase happening as fast as we've been seeing over the past 12 months. And the only thing that can guarantee a loss in an inflationary environment is cash. So that cash we've just seen in the past 12 months has lost 7.5%. So it's a very important reminder to stay invested. Cash is the only thing that we know will lose purchasing power over time in an inflationary environment. And finally, invasion. I love this picture of the bear here on the fence of whether it's going to invade or not. Feels very symbolic of what we're seeing with Russia and Ukraine. This video is as of February 18th, so there could be new developments making this video look a little old. But from today's perspective, we just want to zoom out and talk a little bit about what we're seeing. We are seeing a lot of daily market volatility. Expect that will continue as we have talks and actions coming out between Russia, Ukraine, NATO, and the U.S. From our perspective, this is shocking, I know, but we don't know. We don't know what's going to happen with the invasion. We don't know how markets would react to an invasion. Sometimes you can even predict an event right and yet still trade it wrong. Very simply, look at COVID, right? If you had predicted what COVID and the types of impacts it would have on people and the markets, you might have sold everything. And in the long run, that would have been the wrong move. So very challenging to try to not only predict, but even trade correctly these types of short-term geopolitical events. And in the long run, we think these types of events will fade. That's what we've seen historically from the past. Listed a couple there with Brexit, Crimea, and Greece. Those were huge events at that time. Now they just seem like more of a distant memory. So a couple of actions from this. Here's our yellow brick road. We want to expect volatility. 2 out of every 3 years, the market corrects over 10%. Didn't happen last year, has just barely touched it this year. So that is normal. The average drawdown in a year is over 14%, which we still haven't seen yet. So this type of volatility is normal. Even though it doesn't feel good, it is a normal function of investing in risk assets. So it's very important to have a plan, stay the course, stay invested. This is a great time to dollar cost average. When we've seen volatile markets in years past, a couple come to mind, 2015, 2018. Both of those years had a lot of volatility in the markets, ultimately ended up down or sideways. Those ended up being great years to just consistently average in to the markets over time. 2016 and 2017 were great years in the market. 2019, 20, 21 were great years in the market. So consistently, if you're an investor, to consistently save into a dollar cost average plan, continue to invest over time in the market is a great strategy for when we're seeing these types of volatile events. And finally, having low interest fixed rate debt is still a very great strategy for having in an inflationary environment because that debt, that fixed interest is the purchasing value of that is declining over time as inflation is going up. And so having low interest fixed rate debt is still a very good thing to have when we have these types of inflationary environments. So that's everything that we had for you today. I hope that's helpful. There are a lot of lions, tigers, and bears out there in the markets right now, but we still continue to believe having a plan, sticking to that plan, staying the course, ultimately will get you to where you want to go. Please reach out if you have any questions, and we look forward to talking to you soon.